Good afternoon, ladies and gentlemen. Welcome to Business Today Television and to our special episode of Market Gurus, where we get you to meet professionals and experts who have a deep understanding of how financial markets work, not only in the long term, as also in the shorter term. We are joined today by Mr. Abhay Agarwal. He's the founder and fund manager of Piper Serica, a very well-known individual in the markets. Over the last 17 years, Mr. Agarwal has been offering portfolio management schemes under the Piper Serica Advisors Private Limited. And before Piper Serica founding that, he was with JP Morgan Partners in Singapore. Namaste Abhayji, what a pleasure to host you again on our special shows. This is as good a time as any to check a sentiment in the last street at a time when global macro is deteriorating. How do you see the overall structure of the markets at the present moment when US Treasury yields are the worst since October 27 and the dollar is strengthening? How do you see that impacting our markets, sir?
Yeah, good afternoon, Shailji. First of all, pleasure to be on your show again and talk to you and your viewers. So thank you for calling me. Shailji, what you are asking is something that a lot of fund managers like us are grappling with, because while we do not want to be traders, but frankly, in my 30 years of investment journey, it is rarely that I have seen such a poor global construct on the financial side as we are seeing right now. And as you mentioned, the yields on the US Treasuries and as a result on the corporate bonds has gone up to a level where I don't think anybody expected, even 3 months back,
Yes.
Nobody expected that the 10-year would be well over 4.5%, well over 4.6%, and the shorter term 2-year bonds will be at 5.5%. So I think some of these things that we are seeing have surprised us. And if you go back, and you did refer to the global financial crisis, and if you look at the genesis of that global crisis, again,
Absolutely.
was that the world was over borrowed, it was over leveraged. And as the rates went up even slightly, there were bankruptcies and there were hedge funds that folded over, well-known brands that fell off. I think the rates now are higher than that. And my fear is that there are potential bankruptcies, potential insolvencies that are lurking around the corner. But at the same time, what I see in terms of sentiment, there is no real fear. I think the markets have done very well, equity markets, especially risk markets, over the last 6 months, starting April 1. We have had very strong FPI flows, domestic flows that have boosted valuations, taken some of the sectors to extreme highs in mid cap, small cap space. So in India, I don't think there is any real fear right now. In fact, I'm still kind of surprised by the conversations where large funds are looking to deploy funds. And that tells me that any correction that comes in because of a bad event will be very sharp and will lead to very crowded exit, which will kind of further dovetail into a bigger correction.
Right.
So I think all market participants at this point of time need to be very careful of a couple of things. That oil prices are going back to $100, which is not a good sign. You have a situation where geopolitical risks still sustain. You have a situation where equity markets are pricing in a lot of good things and upsides, no negative surprises. And you have interest rates which are continuing to go up, despite interventions.
Yes.
So that is my view, Shailji, of the global market construct right now.
Right. Abhayji, the good points that you mentioned, of course, the fact that Indian stocks as well as domestic sentiment doesn't seem to be reacting to how bad the global macro has turned out to be in the month of September is definitely a cause of worry and extreme caution, because we've seen the small cap and the mid cap indices rise about 26-27% from the month of April till about mid-September. And as you and I both know, corrections come fast, they come sudden, and they come unannounced. So that is the worry. Since you've seen the markets for so long, share with our viewers how Piper Serica is structured at the moment in terms of what you are doing in mid caps and small caps, and how are you sort of guiding your investors through this potential pain that is likely to hit Indian markets?
So Shanti, we have two funds. We have a PMS in India and we have a Mauritius-based fund called Piper Serica Numero Uno Fund, and they invest in the similar portfolio. We have a model portfolio that we manage. And what we have done is that since earlier this, about 10, 15 days back, we have been booking profits and getting into cash. We are not redeploying right now. If you go back to March, LG, you would remember the participation in mid caps, small caps are very poor. Even 10,000 stocks were not trading. And if there was a, we were looking at a situation that if you want to sell 10,000, 20,000 shares of a mid or small cap stock, it would hit a lower circuit. And then from there, the sentiment has revived to the other extreme that there is very high participation. And at that participation, more than the valuation I've seen, makes tops in mid and small cap stocks, because when the participation again reduces, it becomes a very crowded exit because these stocks have pretty low liquidity. And I think we are getting into that zone of high participation. So what we have done is we have reduced our allocation. We had a 75% allocation to mid and small caps. We have brought it down to about 45% now. We had a 25% allocation to large caps that we may increase to about 30%. And the balance 25% odd we are holding in cash. And that is a pretty high cash allocation. You can say the last time we had so much cash in the portfolio was in 2007, global financial crisis, and then in the COVID, March 2020, because those were extraordinary events. I think that we may get into the similar situation, though I'm not an expert and I don't want to alarm anybody. But since you asked what we are doing, so our view is that we have made very good profit. Our portfolios are up about 40% in the last 6 months. So we want to lock in some of those profits. We have sold a couple of stocks in our portfolio that we thought had already hit our valuation upper zone and gone above that. So we have locked in those profits, and now we are happy to sit in cash for a while, continue to do our research, find new opportunities, and deploy that cash as these opportunities become available.
Wonderful. Abhayji, it's rare for a fund manager to say that he's sitting on cash and keeping powder dry. So two things that I've realized is that one, you're going to have a very, very nice Diwali, thanks to the strong bonus payouts that you and your team will legitimately deserve. So that is one. And secondly, the fact that you've moved into blue chips. I believe the two corpuses put together are somewhere like 850 crore rupees, of which earlier 25% was blue chips, now that is 30%. Am I right, sir?
Yeah, that is right, and we will increase it. So as of now, even when we are looking at opportunities to deploy this cash, we are searching more in the large cap space rather than mid and small cap space, because we are not seeing very attractive valuations in the mid and small cap. So we would much rather deploy them in the large cap space. So that's where our intent is. That's what we are looking at.
Yeah, Abhayji, you are absolutely right. If you look at the valuation matrix of the mid cap and the small cap index, they are two standard deviations away from the mean. Yeah. And we had just shown a graphic for our viewers where the small cap index is up 35%, the mid cap index is up about 27%, and the Nifty is just up about 8%. Fair. That point is very well taken. In terms of headwinds, Abhayji, what are the 2 or 3 things that you see that might impact Indian equities negatively as far as domestic markets are concerned?
Yeah, Shanti, 2 things I see very clearly. One is oil price spike, because we haven't had pump level price increases for a very long period of time. I think after getting to about 106 rupees per liter in Mumbai, where I stay, the prices have been at that level for a very long period of time, and we haven't seen the impact of that price going up by 10 rupees, 15 rupees, which I think the government will be forced to do once the prices, global prices cross $100 or maybe more. So I think that will have a very strong impact on inflation that RBI has been guiding to be in the zone. But I think once that happens, that's something that RBI will be very, very cautious about. So you may have a situation where interest rates in India, and I think the premium difference between Indian interest rates and US interest rates are at probably their lowest ever.
Yes,
So I think
correct.
that will expand. We are taking for granted right now that our 10-year GSEC would stay at 7.1, 7.15, 7.2. But nobody is thinking about what if it goes back to 7.5 and 8, and what will happen to consumption demand and cost of capital for the country as a whole. So the risks I see are driven by a sharp spike in oil prices leading to higher interest rates in India. Second risk, obviously, is the big political risk of, not political risk, I would say the unknown outcome yet of the elections that we will get into in November. And typically, we have seen that the markets get cautious when an event like that happens. So I think these are the two things that we are watching out for over the next couple of months before we get the confidence to deploy capital.
And coming back to where you've raised your stake, and that's blue chips. Abhayji, two private sector banks which have, sort of, let's just not say done nothing. It's one of those life cycle things which happen where a stock doesn't do anything for 5 years or 2 years, and then suddenly in 3 months it gives you returns worth, a gold mine. This deployment of an extra 5 percentage point into blue chips, which stocks have you added, if you may want to share the names?
So we are not looking at this point into the large cap banks, Shailji, for sure, because I think there are issues related to, I mean, if I name them HDFC Bank in terms of, the whole process of and the impact on the numbers of the merger, that still has to come through. And in the other one, Kotak Bank, I think the leadership announcement is still pending. So I think there is some hesitation there, and these banks, I would say, by global standards, are still well priced. They're not cheap. Though there has been a time correction where earnings have gone up, but if you look at the book value multiple, they're still not really that cheap. So we are not looking at that space. We are looking at more into Shailji, a space that has not drawn that much attention yet, which is to do with the farmers' income and the agri economy. So we are looking at companies that cater to crop protection, better yields, farm equipment, seeds. That is where our focus is, because we believe that whole space hasn't done anything for investors for last 5 years. If you see some of the leading players like UPL also. And again, I'll put the disclaimer that the companies I'm naming are not our buy recommendations by far, and we may have a position. But you look at a company like UPL that hasn't done anything for 5 years, 6 years, and is making a strong bottom now. Looks like getting into some pricing power as global agri commodity prices increase. Or you look at some of the smaller players in that space. Plus, you look at a company like Mahindra and Mahindra, which has a very strong presence in farm equipment. So I think that is where our interest is, to back companies that are making the farmers more productive, because this is a space which cannot be disrupted by digital technology. I mean, people are still going to eat food, people are still going to grow crops, and as the dependence on grains reduces, the government is also going to focus on the agri economy because it's a big driver of the GDP. So putting all those two things together, we think that there are, as a sector, a theme sector that we want to play on is the farmer or agri economy sector.
Fair point, given the fact that we have a series of state and one main general election on our way over the next 7 months. So Rajasthan, Chhattisgarh, then 2 more states come up for elections in the month of January, and of course then the big one in May. So farmers will be definitely kept happy in terms of more SOPs being offered to the rural side of the economy, and therefore the kind of spaces that Abhayji mentions will, of course, see a very possibly a bright spark in the coming months ahead. Abhayji, I hesitate to ask you because at the beginning of the show you've mentioned that mid caps look overvalued, and of course you've been very, very sensible in taking a large chunk of that money away from the table and booking it in your bank. But still, I must ask this question, which is on the second rung of public sector banks. Both you and I have seen them over the last two and a half decades. The last 15 have been, the last 15 years have been one of those lost decades and a half where these stocks were trashed, somewhere like 0.25 book, 0.3 book. But there has been a flowering of interest, of delivery statistics, of great balance sheets and phenomenal numbers. Do you think the second rung, top rung public sector banks are making sense to fund managers such as you?
That's a very interesting point you made there, Shailji, in terms of the market perception changing of these banks, and that actually shows you how the same thing can be perceived so differently at different points of time by the market participants. I think these banks got into a zone where they were like ultra value buys, but still nobody had the confidence to buy them because they do cater to a very large part of Indian economy that is not catered to by the large private banks or the NBFCs, because these banks have a very strong, you know, branch network, physical network, where a lot of people still want to go and visit the branches and meet them. And we have also seen that these banks have become quite competitive. Earlier they were, if I can use the word sleepy, they were not, they were just catering to walk-in business. But then we saw that some of them set up housing subsidiaries, other subsidiaries, and then they started aggressively competing with the private banks. The new management that came in, the guidelines that they got from RBI, Finance Ministry, kind of woke them up and made them more competitive. I think, Shailji, right now where they are, I think these banks have already got well priced. The easy money in these banks has already been made by the investors, and now it's a question of what call that you take on the future earnings. Now, because of the government ownership, I don't think these banks will get a very high valuation multiple. I think they will peak out at max 1.5 times book value, or at best 2 times book value. I don't think these banks will, even at the market frenzy zone, also will trade more than that. So, and I think a lot of them have already got there where they used to trade at like 0.3 times book value, 0.5 times book value, and they are well above 1 time book value. So I think they're already in the fair value zone. Now it is up to the investors to see which bank, if they can pinpoint, will grow faster than the others and create value for them.
Right. Abhayji, I think 30 years of fabulous experience has been distilled in a line which you mentioned, that the easy money has been made in the PSU banking sector. It's one of those wonderful observations that you see in hindsight, and I'm sure a lot of our investors will appreciate as these banks plateau out on their charts. But like I said, it's rare to get this kind of wonderful advice at one go and in such a short interval of time. Let's look at other sectors. We've seen some pain in pharma space, which was there for the past 5 years, and suddenly once we get to hear that Cipla will sell a minority stake to a couple of private banks, or even maybe a domestic player which is interested, the spark and how should I say, the pulse is back in the pharma space. Do you find anything attractive apart from frontline pharma there? You are a mid cap and a small cap picker as far as making multiple times gains is concerned for your investors. What are you doing in the pharma space?
Janji, I think in the mid and small cap in pharma space, it belongs to innovators, somebody who's doing drug discovery or playing something unique, because pure generic players in the mid and small cap will struggle to scale up. We've seen that. I think if you want to look at formulations or generic exports business, that space is ruled by the larger companies. Say the Sun and Cipla and Dr. Reddy's and Divi's. So that is the space it is very difficult for the smaller players to compete in and get a foothold. So I think what they are left with is to do innovative drugs, innovative R&D. And again, the problem with that is it's very difficult to predict which molecule will become commercial at what point of time and what will be the upside. So that is why we have stayed away from mid and small cap pharma right now. It's very volatile. The holding that we have had for a long period of time in the space is Divi's. And Divi's for the reason that it is a good mix of formulations, generic exports, plus a very robust CDMO business where they do contract manufacturing, development manufacturing. And that is a space that is a very sticky business. It's not very volatile. And I think that's one of the reasons that companies like Divi's, who are into the CDMO space, get a higher multiple than the pure generic exporters. So I think from an investor's perspective, when they're looking at pharma, they need to be careful that if anybody is trying to make money from just exporting a generic, which is a very competitive generic, export to competition from China, Israel, some of the other countries, Eastern European countries, then that is a risk. But if you have a unique proposition, then that is something that will create returns for them.
Fair point. And we have a common friend in Mumbai sitting very close to your office who commented exactly like this on Divi's Lab about 2 days ago in terms of the strength that it offers relative to its peers and the stickability of its business portfolio. Abhayji, of course, money is coming in droves. Our foreign friends seem to be, booking a lot of gains and taking money out on the foreign institutional side, but the sovereign money, from the Middle East, from the western part of Europe is coming in by the truckloads, and they are buying quality stocks. I wish to understand, when newer investors are coming to you, seeing the spark in the market in mid caps and small caps, what are you telling them in terms of the story that India offers for the next 1 year or 2 years, notwithstanding corrections?
I think our pitch to foreign investors, and a lot of them, when we talk to them, are first time India investors. They have never invested in India. There are family offices in Germany and some parts of Europe where they have heard about India, and they are capital allocators, and they want to allocate 5 to 10% of their portfolio to India now with a long-term view. I think there our pitch is very simple to them. That look, here is a country with $3.5 trillion market cap, which is largely equal to the market cap of Apple. Now, if you just look at it in that simple reference, then would India go to from 3 to 6, 6 to 12 over next 5, 8, 10 years? The answer is yes. We're not going to go back. We're going to go higher. And we are still at a fair distance away from, say, China, with China plus Hong Kong being around 18 to $20 trillion, 6 times bigger than us, or US, which is almost $50 trillion. So as long as we are directionally poised in the right direction, that look, the markets will grow, the market cap will grow to 6, 6 will become 9, 9 will become 12, 12 will become 15, then do not worry about short-term volatilities. All you need to do is to allocate your capital to good quality companies that are growing their earnings predictably over next 3, 4, 5 years, getting stronger, getting bigger, with a clean balance sheet, good management, and ignore the market volatility. Because in smaller markets like India, and India is still a small market by global standards.
Right.
There will be volatility, there will be crowded exits. If suddenly large bout of FPI selling comes, market will crash. But look at it more like an opportunity than a threat, because we have seen Indian market corrects also very quickly. You remember the COVID time, we fell sharply in March and then we recovered even more sharply, thereafter.
Yes.
So,
Yes.
so this is, and same thing happened in the mid and small cap correction that happened, or GFC, global financial crisis. We went up 90%. We almost doubled in 1 year. in 2009. So
Right.
we have that history that anybody who has bet on India at the time of panic has actually made money, very
Yes.
quickly. So that is our, advice to foreign investors, first-time investors to the market, that this staying invested in India will definitely make you money, but you need to have the power to hold on for at least 3 to 5 years to see those returns.
Right. Abhijit, I have often cited this example of a very dear friend of ours who's no longer with us, and he mentioned the fact that, you know, India is a perennial bull market, and sometimes it corrects to the extent of about 33 to 35%, and then it bounces back again. So once that correction is in place from the top of this kind of percentage, one should be ready with the dry powder, gunpowder that you have in your banks, and then go in. My final question to you, sir, is that if you see the UPI transactions that are happening to the extent of 10 billion transactions a month, that's something like, I calculated sitting there once a day, about 3,000 a second. There have to be some winners in Dalal Street, given that strength of momentum that's coming in, and the fact that over the next 18 odd months, you'll see UPI flowering into different languages and, of course, different methodologies. If you put in your binoculars in the new age internet economy which is blooming in India, do you see any winners because of this trend that's coming up?
I think, Shalji, again, very, very astute observation. I must compliment you for that, because, people have still not understood the power of UPI. UPI has made money velocity go through the roof. Earlier where it used to take months for people to receive money, checks used to bounce. Now it's instantaneous. 10 rupee transaction, 10,000 rupee transaction, 1 lakh rupee transaction is instantaneous. And the good thing is that RBI and the government made it free. So it, as a backbone, it's free. There are very small charges that merchants pay, but it's literally free. And I think that has what has increased the trade and money velocity in the economy and helped the economy get to the next level. Uh, Now there are, there are. I don't think there are very direct beneficiaries of this, because UPI is a backbone that a lot of people are using. Payment gateways are using. You can use GPay, Paytm, and apps like that to use that UPI. Banks are using it. RuPay card is being issued. So it's a fantastic development. What has done is it has created a lot of indirect beneficiaries. So you look at the domestic consumption companies, companies that sell apparel, shoes, the retail stores, they are benefiting because suddenly the customer has an ability to pay for large ticket items through their phone. They don't need to carry that cash in their wallet. It makes it so much easier. Also formalize the economy. So a large part of the economy that used to have competition from unorganized players is also benefiting, because the unorganized players are who used to depend on cash are getting shunted out. So again, I think this whole UPI experiment, and not experiment, I would say the initiative, has helped recovery of the domestic consumption to a very large level. And I see the domestic consumption companies, whether they are selling home improvement items like tiles or paint, or clothes or shoes, or anything, they are benefiting because they're getting money immediately. There's no working capital to speak of. The retail merchants, you look at some of the large retailers, whether it is Reliance Retail or some of these other west side, they're getting money instantaneously. So I think that is the part that is benefiting more than any enabler of UPI payment right now.
Right. Abhijit, like always, I have not run out of questions, but I have run out of time. And as always, it's been such a wonderful 23, 24 minutes listening to your phenomenal understanding of how markets work, and more importantly, when money should be taken away from the table. Thank you so much for your time, and I hope we'll be getting you fairly soon, when you've already deployed that cash which is lying in your bank after this phenomenal rally that we've seen in mid caps and small caps. Thank you for your time, sir. Very kind of you.
Thank you. Thank you very much, Shailji, for having me, and I look forward to coming back on your show. Thank you.
Thank you. So that's it, ladies and gentlemen. A fine observer of markets is what Mr. Abhay Agarwal is, and at the moment, he's taken a large chunk away from mid caps and small caps, in which he had invested over the last year, over the 6 months, and booked profit. So he's sitting on about 25-35% cash in his portfolio, and at the same time, overall weightage of blue chips was somewhere like 25% in his portfolio, which he has raised to 30%. These are the two major takeaways from Mr. Agarwal's wonderful chat over the last 25 minutes. Thank you so much for your time, and remain glued to BGTV for such wonderful insights into what is a wonderful rally unfolding on the Lal Street. Thank you very much.
Akshay, I remember last time that we were discussing, you had picked out Tata Consumer Products as one of your topics, and we have been seeing a lot of momentum take place from the FMCG basket. Any other pick from the FMCG space that you'd like to share for today?
From the FMCG space, well,